Hi everyone, thank you for coming to this panel. We've got a really strong group of people here to discuss a very interesting topic today, which is about on-chain money market funds. And there we go, on-chain money market funds versus DeFi vaults for base rate exposure. So I think I just want to, ask everyone to give a little quick self introduction, and also alongside that, maybe share your top line thoughts around this increasingly expanding real world asset landscape, where we've seen like ever so much more like assets on chain today, and then you've got the traditional money market funds being tokenized, as well as you see a lot of more of like crypto native and on chain and permissionless DeFi vaults out there, right, trying to grow their business. So there's like those two sort of movements going on, may not be competitive or mutually exclusive, but just like share your thoughts of like what has happened in the past like 12 months in terms of the speed of growth, in terms of the diverging kind of sort of attraction in those two areas. So,
yeah,
go first.
Yeah, sure. So, hey everyone, I'm Ryan. I'm a partner at RockawayX. We do three things. We do investing, we do liquidity provision, and we run infrastructure. We also have a rapidly growing vaults business, roughly 100 million AUM in under 4 months. Very proud of that. And what do I think about what's happening with RWAs and stables and tokenized everything? Like, bullish. I don't think it's going to stop. Sure, you'll have some bumps in the road where growth will slow and everyone will say it's over, but I mean, man, this is inevitable. So yeah, bullish.
Hey everyone, Jonathan Mann, head of DeFi strategies at Bitwise. I'm sure most people know Bitwise as a ETF issuer. That's our biggest business, but we have a large growing staking business. We have active management with derivatives trading, and then now a vault on-chain asset management through vault curation business. And I lead that segment of the firm. Yeah, I totally agree. Super bullish on-chain asset management, stablecoin adoption. It essentially vaults to us is an extension of the stablecoin thesis. And so, everyone adopting stablecoins, it's fast, it's transparent, it's great. Now that you're on chain, why would you ever leave, right? And so you have these balances. They need to generate yield. This is where we come in. So yeah.
Hi everyone. I am the Chief Growth Officer at Concrete. Concrete is a vault infrastructure provider. We run curation in-house as well as work with external curators. We manage about 1.1 billion today across ETH, BTC, and stables. We actively deploy into things like RWAs. I think we come from a perspective of believing that they are going to continue to grow and proliferate, and we see them as a base asset to be able to then go and borrow additional assets against and run uncorrelated strategies. So we're excited about them growing within the ecosystem. We're excited to use them, and understanding recourse and really bringing high quality assets on chain is going to be vital for us to continue to grow and succeed.
Hey everyone, my name is Bree. I lead institutional growth at Morpho. Morpho is a permissionless lending protocol, and specifically we are focused on, or I'm focused on bringing institutions into DeFi, or bringing them into an on-chain credit market. So when we think about that use case, yes, the conversation is about RWAs, but I think we have a number of challenges ahead of us in actually making those assets grow and scale on platforms like Morpho. So I think we'll get into that, but excited.
Yeah. So Dennis, while you're on that topic, right? Like I want to just like point out that I'm quite impressed personally by the staggering growth in terms of total on-chain deposits in the Morpho ecosystem. You guys are getting into institutions, working with funds, and being super creative and innovative. Essentially I feel like the scale is not just by like tokenizing a fund or just moving sort of the crypto onto like a consolidated like a vault, but you guys are doing something more to make sure those crypto assets are usable as collateral and so on and so forth. So just wanted to like hear your thoughts on what has actually changed, because the growth is relatively recent. I think the last 12 months it specifically kind of grew from a few million or something like in that neighborhood to like close to $1 billion now, right? Like I don't know what the exact number is, but like just share like what is actually the catalyst in the last like a year or so.
Yeah, I mean, I think it's a representation of the overall market growing, and Morpho has captured some of that. But the RWA market has gone from 0 to several billions within less than 12 months. And so the opportunity of tokenizing an asset isn't particularly exciting if that asset is sitting in, if it's sitting in a tokenized fund or it's sitting in some type of wallet, versus sitting in a brokerage account. It's a tokenized version of the same thing. So you have to think about what is the utility that we can get from that. So if I can pledge that as collateral, can I then borrow against that? So that's the use case. If you have a yield on yield scenario, you couldn't do that before off-chain. Now you can do it on-chain. Institutions are understanding that. And I think we've solved the tokenization part. I think the challenge then is everything around the infrastructure and supporting that asset. What does the secondary market look like? How do we price it? And how do we get an audience that is familiar with DeFi, actually familiar with typically a tokenized version of an off-chain asset? And I like Jonathan can talk to that as kind of one of the curators on Morpho. And really, we rely on institutional curators to be able to talk to TradFi, help them understand the vault and market structure, and some of the challenges but opportunities that kind of come with that.
Thank you. And then just kind of shifting, since Bitwise and RockawayX are both pretty prevalent in the curation of all business now, right? But also happen to be quite institutional and based on your background in the main business. But I sense like the approach towards building institutional yield products on chain are slightly different between those two firms. I mean, there's obviously a lot more like ETF, background in the Bitwise. It's like business lines and how you guys think about maybe was more like ETF 2.0. RockawayX might have a very different approach as well. So I guess not to ask what you disagree but just what's your unique take on the right way to build institutional grade yield products.
This is where we fight.
Yeah.
Okay.
That's I mean my
No, honestly, I don't know your business, but I think the way that we look at it, probably the unique way that we're approaching it is from a perspective of we are a regulated asset manager. We already have an existing book of business that's like $10 billion. Used to be 15 back when Bitcoin was higher. We won't talk about that, but we have legacy business at this point, right? And so us coming into this space, we have to approach it in a certain way. Not to say that other people don't approach it that way, but just because of who we are and the businesses that we have to approach it a certain way. And so that may inform and impact the way that we manage risk and approach risk compared to maybe others. That might be speculation, but that's the way I look at it.
Yeah. Look, I don't know if it's perhaps less exciting to talk about the differences between RockawayX and Bitwise, and it may be more exciting to talk about, I think, why crypto native asset managers are really going to crush it, and why I think you're seeing traditional financial capital come into crypto, and I think it's structurally disadvantaged. The crypto guys are going to win this market, I think, handily. I think there's 3 reasons why. The first is just being crypto native and the ability to look at an asset and very quickly understand it and do the due diligence. And we've worked with the team before, and we know all the crazy idiosyncrasies of the space. People in TradFi look at our assets and they're genuinely confused. They're confused by the structure of the asset. They're confused by the marketing. They don't speak the same language as the team. So we have just a structural advantage to be able to do due diligence. I think TradFi cannot. The second thing is, look, we don't have the organizational baggage, I think, that the TradFi incumbents will have when they want to touch crypto assets. I mean, look, I've worked in TradFi. In every TradFi institution, there's a young person that's very into crypto, and then there are legacy players that absolutely hate that young guy and do not want him to have any power and pushing across the crypto thing. There's ops guys that are of that demeanor. There's compliance people that are of that demeanor. It's very hard to get these crypto things through and to be able to touch the assets that you can to generate alpha in vaults. So they're going to be hamstrung from an alpha perspective there, and just the compliance person will not let them touch that thing because they're confused. And I think the last thing where like it's like very like to plug Rockaway, we have been running infrastructure for a long time. We have a ton of smart contract developers who have seen it all in crypto, all the pitfalls. So when we underwrite something, smart contract risk is always top of mind. It's kind of top of mind for the market today for the first time in a long time. Like it's really like, even the degens are talking about it, right? But like we have the people, the mathematical geniuses who understand the smart contracts in-house that can mitigate that risk for us. And like, I think, traditional financial institutions that want to participate, they just don't have that muscle that we have. So yeah, just another edge there.
Yeah, really, yeah. Go ahead. Add on.
Yeah. Were you? Well, just to be clear, I'm sure you don't assume that we're like.
Not at all. No.
Okay.
We're
All right,
on the
cool.
same team. We're on the same
Cool.
team.
All right, cool. Because I totally agree that like like a Morgan Stanley or Goldman Sachs coming into the space, and I'm sure they will at some point. We'll have a lot of like catching up to do. Yeah, like the way that we're 200 people strong, so we have all these capabilities. We've had them. It's just we haven't flexed that muscle until this year. Totally agree with you. Like crypto nativeness really, really matters, especially in DeFi, but across all of crypto investment. Also do believe that having, especially now with RWAs becoming more and more important, having that TradFi upbringing is super important as well. So yeah, I think like there's gonna be a lot of curators who will need to catch up on the kind of traditional TradFi, credit underwriting, all those things, and then there's gonna be like the traditional firms that need to catch up on all of the like crypto nativeness side of things. So yeah.
That's a perfect segue into the next question I was going to have for Luke at Concrete, right? A lot of recent development in the growth of TVL, AUM are largely dependent on the curators, how good the curators is attracting, convincing TVL come into their vault, and the vault sits on a specific protocol or a vault infrastructure, and that's where you guys reach the 1.1 billion, right? You have to kind of take the strategic bets on the curators you work with, but also kind of like putting the common sort of like public goods, so to facilitate the curators and grow together. I know you guys also maintain the LP network. You do a lot of stuff that is like not a typical vault infra provider has. So maybe you can like comment on that, like how you think about the growth in general, and yeah.
I mean, I think the interesting thing about all of this is I came from a custody background, staking background. Like these industries have been commoditized, right? Because largely they're undifferentiated in a lot of ways, and we can split hairs about RPCs and all this other shit. But like it's really difficult for people to discern what the actual value is in comparison to one another. I think the thing about curation versus vaults versus all this stuff is vaults implicitly are really boring. The curation is the important part of how this all operates, and I don't think that this is going to be a commoditized industry in the way that everyone perceives these things differently. In the way that RockawayX, the way that Bitwise does it versus Concrete is like independent for a lot of reasons based upon who our LPs are, right? And I think a lot of the conversation around like who is the best curator, like the concept of passive assets coming to a lot of these vaults is like non-existent in my opinion. People are getting these assets because they're out doing the legwork to convince people that their strategies work better than other people's strategies. And I think with that, like this will not be a commoditized industry similar to how custody or how like there is no one winner take all. So I think for us, from our perspective of being a vault platform, we do things on the underlying tax implications and really focusing on how we do our NAV sweeps and things like that that are nuanced and a little bit different, but aren't going to be something that makes someone come to us and go like, hey, we want you to manage all of our assets. So for us, we want to work with any curator, every curator. We are like very, very large depositors into Morpho, into curated markets. So like for us, we are a partner as well as an infrastructure layer on top. But from my perspective, like I don't think anyone can pick the right curator. Some of the largest, most successful curators are the ones that are having problems with balances getting like moved around or having losses. So I don't think that is really like the prevalent piece. I think it is what is their risk curation strategy, how do they do it, and what LPs are they going to specifically to go win those balances.
Yeah, that's a really good point. We haven't quite touched on the assets itself, right? There's obviously as everyday passes by, there's more new types of RW assets, and the assets that currently are still, the original, the OGs of like assets for curation are stablecoin, and there's the USDC, USDTs, and there's the BTC and ETH. But we're kind of moving past that, right? Like now you're seeing a lot more modular and interesting, complex, maybe yield-bearing product like crypto assets moving on chain. As the kind of the money market rates or the treasury rates continue to compress, which I think anticipate to go below and lower, right? Like below 5% for sure. But like, how do you think about, what are the on-chain assets have proven that they're worth like to become the replacement of like a simple money market products right now? Any specific assets that excite you think will grow really fast in the next like 6 months or so?
Yeah, I can. I mean, look, we're RockawayX is an investor in this company. It's called OnRe. It's bringing reinsurance yields on chain. For anyone in the fixed income space, having an uncorrelated, stable, high-yielding yield source is like it's the golden goose. You want that in your portfolio for like ballast, right? It's like it's the core. It's the stability in your portfolio. Everything else moves around, like reinsurance risk. It's historically very high yielding, upwards of 15%, and it's very stable and diversified, and it's generated really attractive returns for fixed income managers for a long time. You don't have that in crypto. You have a lot of very correlated yield sources, and crypto portfolios are missing that ballast. We're big fans of OnRe, have 160 million AUM, second biggest RWA in the Solana ecosystem. And we think that, and it's an incredibly scalable source of yield. You see a lot of these higher yielding yield sources, they can compress very quickly because they're constrained trades. Reinsurance is a massive market. There's no end in sight to the scale there. So we think that's going to be an incredibly successful product.
I think our LPs are a little bit like the 15% return rate is something that isn't as attractive to our LPs, just given the fact that normally they are like hyper focused on principal protection. So we have a view on something like OnRe as something that's highly scalable, highly valuable to the ecosystem, difficult for us to sell to our LPs in a way that is like really meaningful. We do a lot of optimization on Morpho. We do a lot of like money market work, and then we work with people in the real estate industry and are focused on assets that are yielding anywhere between like 7 and 8%. And this is like, back to my point, is like different LPs, different strategies, and I think both have their value and implicit use in the ecosystem, and it's a matter of like how you blend these portfolios and how you select the complementary products that exist within these curated markets. So for us, like very focused on that 7 to 9% range, and I think that's kind of like our sweet spot. And I think a lot of the stuff that's going on in insurance as well as the housing market is really interesting to us.
I don't know if,
Yeah, it's funny when we talk to institutions, they don't ask us about yield. It's actually one of the last things that they mention. Everything else comes before that, and almost if those things don't come before that, yield is not brought up. So custody, compliance, regulation, security, everything around the protecting principle and transparency around flow of funds. And if they can get comfortable on that, then they can talk about yield. But institutions, I think, are looking at SOFR plus 50 or 100 basis points, with underlying collateral that they can trust, liquidate, and scale. I haven't been in a conversation with either a large fintech or an institution where the yield was not high enough. It's everything else around that. And if that's in place, then yield is a conversation.
Yeah, I actually agree. I think like at least for the majority of vaults, they're being treated as like short-term savings accounts. You can go after higher yields, and like maybe the LP into that vault is like has a different type of purpose for making that deposit. But most people are treating this as like short-term savings, and so then essentially the question becomes, is it worth it? Is it worth it from a risk-adjusted basis to either deposit into like a prime market, or is it worth it to like hold it in your own bank account, or is it worth it for you to like try to buy a tokenized money market fund, right? And so like, I think there's been a lot of like questions of like what's the right rate for like a prime market, like prime vault. There was a probably sparked by the number of hacks, and also like at some point, prime rates were lower than T-bill rates during like, I think March. And so I think like, we had a lot of debate about this internally as well. If you take like a very kind of narrow view, you're like, that makes no sense. Like prime rate should have a spread above SOFR or above T-bill. But at the end of the day, it's like, okay, but like people are still doing it. So who are you to tell them that that's wrong? I think a lot of it is a convenience factor, right? Like if you're on chain, you may not want to take your assets off chain, and then the average user doesn't have access to mint a tokenized T-bill, and so like the best alternative is to just put it into a prime vault. So maybe that's one component of it,
Yeah, thank you so much. I think we're up on time, 2 minutes left, and maybe just like quick round of through like what would it take to unlock the next large onboarding of institutional serious capital, right? Maybe it's, I don't know if it's a custody solution, it's insurance, KYC, some other regulatory clarity. But yeah, curious to hear what you guys think is that thing that's going to unlock growth next.
I can start. I think you talked about it there. I think custodial transparency. How can I have my assets sitting in qualified custody, apply those to markets, and then take liquidity from those in a safe, compliant way? Two, from a regulatory perspective, if I have a vault and I'm putting capital into that, but if I'm putting a stable coin into it, fine. But if I'm putting other assets into that, what sort of securities law implications does that have, both across the US and MiCA? And then I think we don't need more RWAs necessarily. I think they will come as a consequence of getting it right. But I think we still need to get it right. I think the tokenization piece is largely solved. I don't think it's a technology problem, but I think it's a sense of orchestrating an asset issuer, having that collateral in a market, and then using that as a case study to show that the oracle, the pricing, the secondary markets can all exist to support that scale of that asset.
I'm in the same boat. I think the custody market is the one that's like completely ripe for real action in that way, and I think people like Bitwise, people like RockawayX coming into these markets is so meaningful because people trust them and implicitly will continue to trust them. And I think allowing for those assets to find ways to enter these markets with people that they trust, with balances that have long track records, I think is going to be incredibly important. And we're like hyper focused on how do we unlock as much of those assets as humanly possible over the next 3 months.
Yeah, I think honestly, I think the adoption is happening. Like we're seeing a lot of people that are super interested in vaults as a vault manager, as a vault allocator. So I think it's all happening already. So
Yeah, time. It's all it's going to take, time.
Yeah, be patient. It will follow. Thank you so much. Really appreciate the input and insights today. Thank you, everyone, as well.